Okay, so this is my second take because, I had an epiphany about something, and by the time I got 5 minutes into the video, I totally lost track. I started talking about the history of money and what money really is, and what I think it is anyway. I started talking about the fact that capitalism has really existed since human beings bartered goods in tribal societies. But that's a video for another day. So, what I want to talk about right now, because I had this epiphany, just because I looked at a graph and I just had this epiphany. So take it with a grain of salt, because chart epiphanies, if you follow financial news, are hit or miss. But let's go here first. I love this graph. If you want to see what the Fed is doing with the quantitative easing, just go to this graph right here. I need to favorite this. I'm going to favorite that. Can I? I thought I already signed into this fucking shit. Okay, in order to favorite this, I have to sign in. I think I have Fred on my phone, so I already am have a profile, but I don't think I've signed up here. So if you look at the asset purchases, this is quantitative easing. Basically, the Fed is, uh, I don't know exactly how it works. So as far as I know, money is created either by the Fed or the Treasury, and it's not even printed anymore. By the way, they just make it on the computer. They don't even print the money. So they create dollar units on the computer, and they use those dollar units to buy treasury bonds and mortgage backed securities on the open market, on the secondary market. So they go to the credit market with this newly created money, and they buy billions and hundreds of billions, of 100 every month. As you can see, they've been buying $120 billion of bonds, and they just keep them there on their account, their balance sheet. So now they're accruing all of these bonds on their account. And what that does is that keeps the interest rates low. So let's do a little experiment here. Let's go from 2021, June of 2021 to now. June of 2021, right about here. We're close. So June of 2021 is right here. Boom. Right about there. June of 2021. The Fed buys a bunch of shit, a bunch of bonds. Then he buys like a trillion. How much is that? Uh, a few $100 billion of bonds. And what does the Treasury yield do? The Treasury yield goes goes precipitously down. There's always going to be these little jitters because people are buying the dip and people are trading and doing their thing. But you're always going to have these little jitters. Then they start selling some of these bonds. So towards the end of June, the last week of June, the Fed, last week of June, let's see, where is that? Yeah, right about here. Right about here. And you see how the bonds go up a little bit? Look at this. last week of June, starting on the 23rd, the Fed offloads a few of these bonds that they have on their balance sheet. June 23rd to June 30th. So we go to June 23rd, June 30th. It was like it had a big, as they started selling the bonds, there was a big upswing. Okay, so you can go on the graphs, you can go on the charts, and you can find all of these, you can find correlations, and it's really apparent what's going on. So my epiphany is this. Look at the graph. Oh. Look at the graph here. So this is 2000 since August or September of 2021, August 25th to now. And you can see that when the Fed goes on these little buying sprees, it's a pretty steep climb in assets. They're buying a lot of bonds. And then they peter out a little bit, and then they sell a few. And then they go on this like maintenance cycle. And then when they feel they really need to buy some bonds, they buy them. And that keeps the bond yields down. Why do we need to keep the bond yields down? Because the bond market is the basis of the entire economy. Perhaps it shouldn't be, but it is. Especially since, you know, the bonds, the debt is what keeps our economy afloat. And that goes back to, really, I think it started in 2008 when our country became dependent upon debt, not death. Instead of allowing the economy to crash and allowing all of these worthless companies to die, companies like GE, companies like Target, they should have been bankrupt in a year. Instead, the government gave them a way to survive a lot longer than they needed to because they kept the interest rates really low by buying bonds. So the epiphany is this. You can see the rate of change every month in the last 6 months, 7 months has been more or less the same. You notice how the maintenance cycle gets shorter every time. Now here we have November. December would be the first month that the Fed committed to buying less bonds. Now look at this. You have the Fed purchasing much less assets. That's because they can't, because they've committed to not purchasing more assets. On the same token, you have the treasuries, which I bought a put on these because I could see this coming. After last week, I didn't believe that the Fed was actually going to go through with this, with buying less, with slowing down their asset purchases. So I said, okay, after last week of steady climbs, let's zoom in. So after last week, I saw this happen. By the end of the week, I said, it's time to buy a put, purchase a put on, I chose corporate bonds, a corporate bond ETF. We had a little bit of this because the Fed just went and used all of their ammunition. We got here, and the Fed said, oh my God, we got to slow this down. So they used all of their 100 billion or whatever they can buy. It doesn't matter. By the end of the week, last day of the week, it starts going back up. So my epiphany / prediction is we're going to hit 200 basis points on the 10-year by the end of the month, maybe by the end of next week, but surely by the end of the month. I think it's possible we hit 200 basis points by the end of next week. If you look at the rate of change here, we're talking between 1231 and 13. You go from 151 to 162, 10 basis points. The next day, 4 basis points. The next day, 4 basis points. The next day. You get the point. So, if you're doing a put on bonds right now, you should be good. Inflation's really high. Bond yields are rising. Real interest rates are still deeply negative. The smart thing to do would also be to buy gold stocks. Not necessarily gold mining companies. I don't really trust them. Gold ETFs are another thing, but I hear gold royalty companies are pretty good. Or just buy physical gold. And you're not buying that physical gold to make money. You're buying physical gold to preserve your wealth. I'm out.